Lord Lonsborough.
Good afternoon, Chancellor. Can we zero in on what you describe as the key problem of the economy, which is the critical issue of low levels of productivity in the UK? And we continue to lag France, Germany, US by very wide margins, about 12 to 20% in terms of output per hour. And we have done so for decades. Now, the UK's productivity in this first quarter has actually fallen by 0.2% compared to a year ago. And it's standing now at just 1% higher than it was 5 years ago. And it may well drop in Q2, given what's happening to GDP numbers. So my question is, how is the government seeking to address this productivity challenge? What specific policies will turn the dial, and when can we expect to see results?
Yeah, so there are sort of three things that affect, I guess, the productivity numbers. It's physical capital, labour supply, and that's the quality of the labour supply, so human capital as well as the numbers, and then total factor productivity, so technology. On capital, I'd say, sort of an assessment of the first year. I think on physical capital, that's where we've done most in this first year. I've mentioned the £120 billion of extra CDEL capital spending by the government over the 5-year period, keeping capital spending by government flat as a share of GDP rather than it falling actually quite substantially, which was the plans that we inherited, but also using financial transactions through the National Wealth Fund and the British Business Bank and other public financial institutions to have additional capital spending, and then using things like the National Wealth Fund to leverage in private investment, 3 times as much private investment, and actually that's a model we've used as well for Sizewell C, where the National Wealth Fund is the sort of debt underwriter for that project. And as I said to Lord Pettigas, we've managed to bring in £120 billion of private investment just in this first year of the Labour government. On labour supply, you would have seen, despite the increases in the unemployment rate, we've also seen an increase in the employment rate. And those two things can obviously be consistent because what we've seen is a reduction in economic inactivity. And that's really positive because we are still the only OECD country, I think, that's got a lower participation rate in the labour market than before the pandemic. And so reducing those economic inactivity numbers are absolutely crucial. The first step is that you move from being inactive to looking for work, and then hopefully you move into work. And there are still around 650, 700,000 vacancies in the economy. And, we want to better match the people that are available for work with the jobs that are available. And we want to help those people who are currently economically inactive, whether that's because they took early retirement and maybe now perhaps regretting that, and that is the experience of some people during the sort of COVID period, whether you are a parent who is struggling to balance work and childcare, or whether you're one of the growing number of people on sickness and disability benefits, where we know that there are many people who are desperate to work but are not given the support. We also, in the spending review, invested significantly in both apprenticeships and further education, because that has been the sort of Cinderella service of the education system this last decade and a half. It's great that we've got 50% of kids going to university, but the 50% who don't, which in my constituency in Leeds Western Pudsey, there'll be the majority of kids don't go to university. So investing in FE and apprenticeships is really crucial for this government and our wider objectives around opportunity. So we've done some of that spending review, but I certainly think that's an area where we can do more to address the productivity issue through improving labour supply and human capital. And then the last thing is around sort of technology, total factor productivity. And Andy Haldane, former chief economist at Bank of England, talks about this long tail of low productivity firms. And the DSIT secretary, Peter Kyle, he's sort of got three focuses in his area. First of all, it's attracting businesses that are at the technological frontier. Obviously, that is crucial for growth, and we're very good at that in Britain. We've got a lot of very high-skilled people. I was at Imperial College this morning. That's an area where we are good, but we shouldn't rest on our laurels. The second area is using technology better in delivering public services. That's this issue about not just how much we spend on public services, but about getting value for money. And then the third is the sort of point around that long tail of productivity, about better take-up of AI and technology by smaller businesses and less productive firms. And so we're working in all of those areas, and there is a big opportunity. You know, the IMF and others say that if we integrate AI and technology, we could boost productivity by 1.5%. Over the next 10 years. So there's huge opportunities there, and we've got to seize them, but we are...
On planning, a really good example of how it is actually possible to do that.
My concern is probably more about the short term, in that the current forecast in the OBR looks very optimistic, and I'd say ripe for downgrade, and that's echoed by the consensus of independent forecasters. And I think the Bank of England has actually downgraded its productivity forecast to 0.6 or 0.7%. So that's going to have an immediate fiscal impact this autumn, is it not?
The Bank of England's forecast of productivity, long-term productivity growth, is 1%.
Long term, yes.
Yeah, and that's what sort of drives the models, really. But the OBR is higher than that. The number I gave you earlier was just slightly wrong. So the IMF analysis suggests AI could boost UK cumulative total factor productivity over the next 5 years by 1.4%. And so I guess that's the point that sort of Steve Farrington is making, that there have been a series of shocks over the last few years, whether it's the sort of global financial crisis, COVID, Russia's illegal invasion of Ukraine, that have all had a negative effect on productivity and growth. But actually, if you look at some of the underlying drivers of productivity, there is perhaps a reason to be more optimistic in the future if we can contain some of those shocks, in part by building a more resilient economy, and that's what we're trying to do with clean energy, homegrown energy, for example. But some of those underlying factors about the increasing use of technology might give us a bit more cause for optimism.